Welcome, everyone. I'm Mike Brashazade.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome back to another exciting episode of the What Matters podcast, where we dive into conversations that truly matter. I'm your host, Mike Brashazade.
And I'm Ashley Ward.
Today, we're thrilled to have Michael, CEO and founder of Wellspring Financial Advisors, joining us. Michael brings extensive experience in estate planning, charitable gift planning, business succession planning, proactive tax planning, and family governance. His commitment to building strong client relationships and providing customized financial services has helped his firm thrive since its founding in 2007.
Michael's deep expertise, along with his leadership in his field, is reflected in numerous awards and honors he's received, including the 2024 Distinguished Estate Planner Award from the Estate Planning Council of Cleveland. We're excited to have him with us today to share his insights. Welcome to the show, Michael.
Thank you, Mike. Thank you, Ashley. Pleasure to be here.
Well, it's a pleasure having you. Let's dive right into our conversation today. So let's start by hearing more about your journey, Michael. Could you tell us a little bit about your origin story, your early experiences, and how it led you to establishing Wellspring Financial Advisors?
Great. So started as a CPA, not the best route for probably financial planning overall for most, but I think for me, graduated with an accounting major, got into financial services businesses, worked for a firm, and was fortunate. It was client facing for my role there when I was there, early age when I was around 26. So I was in a great place at that firm, and then kind of worked my way up until I kind of decided I wanted to branch out and set up Wellspring back in 2007. Again, probably not the best time to set up a financial services firm in 2007. A couple
I was
things.
just going to ask you that.
Yeah, we can get back to that, Mike. There's a couple things going on that year or those years. But ultimately, when we started Wellspring, the whole idea was to create a true family office. That word is just abused. What is a family office these days? And maybe we can get a little bit into that. But ultimately, creating a family office where there was one phone call solution where ultra high net worth families would come. You would do all their taxes, preparing their taxes, do tax planning, pay their bills, do their books, do financial planning, do estate planning, do investment management, both the public markets and private assets and alternatives. And then I think most importantly, deal with the family. So there's a saying, shirt sleeves to shirt sleeves in 3 generations. First generation makes the money, second keeps it, third spends it. So 90% of the money is gone by the end of the 3rd generation. So part of our niche back then was getting into family meetings, family governance, and we're really working with multi-generational wealth. So here we are today. We've gone from 3 families to 74 families. AUM is probably around $4 billion today. And 75% of our families, I'm in Cleveland, are outside of Ohio. So most of our families come from outside of Ohio. And so we've been very blessed to kind of be where we are.
And how many clients did you guys say you serve in the ultra high net worth sector?
74 families.
Wow.
Yeah. So it's it's high touch, obviously.
Yeah.
Wow. That's really cool. So let me ask you this. What does the average family have in investing in you guys there?
Yeah, and so I guess that's a great question, because I think it depends. We look at total net worth because a family may have we've got a couple $1 billion families that we work with that may only have $50 million of liquid assets, but there's so much other stuff outside of liquidity. So we're a little different than a maybe traditional RIA, where we're registered with the SEC obviously because we've got assets that we manage, but ultimately we're looking at total net worth. So if a family comes to us and they've got our minimum is $50 million for a new family. So if they come to us and they've got $250 million, of which 200 is an operating company, that's okay, because there's so much going on from all the things that I just talked about as far as the laundry list of items outside of just true investment management. We had a family just recently that sold their business for, significant over $500 million. And we were managing $2 million before that as far as liquidity. And so again, given the family office model, it's a little bit different than maybe your true RIA, which is, I don't want to say asset gathering, but truly is maybe more investment management and then putting their services under their AUM fee.
Gotcha. So you're saying you guys have it's $4 billion. That's assets under advisory.
That's liquid. Yeah, that's our liquid. That's what we file with the SEC. So total net worth is probably $6 to $7 billion. Looking at
wow.
So averages over 100 million, per family.
Wow. So talk to us. If you could talk to us about Wellspring. You told us about what got you started. You know, you guys have been in business for what now? 16 years.
It'll be 18 years next February.
So you started in 2007.
Okay, here we go.
Okay. So what was your AUM when you started the company there?
Oh gosh, it's like a couple hundred million. Yeah, 250, I think, somewhere around there.
So in 08, it got wiped down to about 3 million.
Yeah, it was zero. No, it went down. Actually, Mike, we were fortunate. We got a really big client in December of 2007. That was their net worth was like 500 million, and so that the AUM did go down, but obviously we're looking at a total net worth that went up. So,
wow. So so you guys started in 2007. I mean, you had a couple years of things kind of being a bloodbath there, and going into where you guys are at now, and let's take COVID out of the equation. How has the growth taken place there?
So, I think the RIA industry is struggling with true organic growth. I mean, our revenue model is a little bit different because we actually track time and we work on kind of a retainer basis based on hours, and then AUM for investment assets. So, looking at our revenue stream, only a third of our revenue is coming from AUM. The rest is like 1/3 tax, 1/3 financial, family governance, family meetings, all this state stuff, and then a third from is coming from true management, like asset management. So kind of our model is a lot different, and so I think a couple things. One, with that model, the good news is I don't want to say we're recession proof, but we're not just subject to the market. So if the market's going up, we don't really get paid more because it's a flat retainer. If the market goes down, we're not getting paid less. And I think the problem with AUM fees overall, and I think there's a lot of comments in the industry right now and questions about, is this model broken? Where is the industry going? And it's easy. AUM's, it's transparent. You know the number, and I guess if the value's there in your assets, if you were a client, your assets are going up and my fees go up, you might say, well, you're doing well because the assets go up. The problem is, COVID, 2008, market goes down. Your advisor, Mike, is going to be spending so much more time with you, and at the time they're getting paid less. And so it's kind of like it is interesting in the industry that they're still so tied to AUM. I hope to see that change. There was a recent fee analysis by Bob Barris that came out that's really good, that's looking at the industry. But ultimately, again, because we're more of a family office, multifamily office, our structure is a lot different. Our fees are a lot different. Our services obviously are a lot different. So as a firm, it's a little bit, I think you've traditionally talked to more, investment management based on your previous podcasts, which are great, by the way. And I think that we're just maybe a little bit different than the normal.
So how many total advisors do you guys have at Wellspring?
So we've got 29 employees at our firm.
And how many are client interfacing?
So we're set up, we have an internal tax department, internal investment department, and then we've got 4 client-facing teams. Each team is kind of set up like almost like a law firm where there's a senior managing director, manager, senior associate, CSS, administrative, and each team of 4 is around 20 families. So we got 74, a little capacity, but ultimately we're trying to have high touch. Clients, because we're doing everything. It could be coordinating a wire or a capital call, or talking about their fourth quarter tax payments, or looking at their estate plan, or looking at insurance, or scheduling the family meeting. We're probably talking to them every week about something, and because there's so much to do, and so we're looking at high touch. And so we've got 4 client teams, and each advisor has around 20 families.
Yeah. It's funny that you say that because I mean your clients have a heck of a lot more with you than I have with mine. And
it's just a couple of zeros. Move a decimal and you're there. Don't worry about
it. And I'll tell you this: I'm on the phone with my advisor probably every other week. Actually, I'm such a pain in the butt. They actually shifted me onto another team, right? Yeah. So, but I will say,
or you're special, Mike, and there might be some, look at it a different way.
So have you guys done that all through organic growth?
Yeah. I mean, That's ultimately, again, we had 3 families, now we're at 74. I mean, I used the word blessed before, and I kind of mean it because we've grown by referral. We don't market really. Um, our ADV, we get calls all the time to be on this magazine or this list or that. We don't really publish on those lists because I think, frankly, no one really cares. I mean, our clients don't care. I mean, our families that we work with do not want us to grow fast, right? They want to be the most important client. And so I think, we've got many core values, 5, but our first core values, clients come first. And I think that's the mission that we always look at. If we're the trusted advisor and we're very proactive in delivering that service, we get the first phone call on anything. It could be, we did a client satisfaction survey. We do it every couple of years just to check in. And one of them came back that, yeah, if I had cancer, I would call you. And it was interesting, but why would you call us? But again, the trusted level of that relationship. And every one of our families has advisors. So they have an estate attorney, they have a banker, they might have an outside CPA that they love. And we don't disrupt those relationships, but we're kind of I guess, lack of a better term, maybe the quarterback of everything. And so we don't want to disrupt relationships, but if they don't have any, then we kind of take over all that stuff. But obviously there's a lot of needs from the level of clients that we're working with and the families. And I think clearly, I think, I said this, I met with someone today for lunch, and I think at 100 million, which is maybe our next step, where is our minimum, I would say that the 2 questions that I get the most are not the financial ones, because frankly, that's all table stakes. Firms are expected to be good with managing money and beating the S&P, or proactive tax planning and saving money, or having a great estate plan that is titled properly that saves a bunch of tax, or whatever it is. So that's all like expected. But I would say families, what they ask are 2 things. One, how do I not screw up my kids? Because maybe I didn't have this money growing up and I don't really know what to do. And so that might be the first question. And the second question is, boy, I would really love to live as healthy as I can, as long as I can, because you've got all this money. And so we're looking at services to say, how can we do both of those things from a partnership standpoint? Obviously, from a family meeting, we've been doing that since we started. True family governance. We do communication exercises, value cards exercises, charity conversations on charity. So we really get into the issues of, if it's that 90% by the end of the 3rd generation, typically it's not because you pay too much in tax or you make bad investments. It's because the family's not ready. And so how do you get them ready? You got to work at it. So you have to prepare them for that.
And so, when you're talking about growth there, in my research, I'd seen from 2023 to 2024 was a pretty significant growth for you guys. Do you mind me asking what had taken place there?
Yeah, and again, this is why I don't like the ADVs, because we went from 2.4 to 3.6 billion in a year. You're like, oh my gosh, that's amazing. We had 2 things happen. One was that client that I said that sold a business where we were managing 2, and now it's over 500, right? So that shows up now. We were working with that client before. We were doing all kinds of things for that family before. It didn't show up before. And so it didn't show up in the ADV because we weren't managing it. And so that, to the outside world, is like, oh my gosh, that's great growth. Well, it is as far as AUM, but that was a current client of ours, right? And so obviously the relationship changed, and obviously there's a lot more services that they needed for investment management versus what we were doing before. The second was, this is a great story for us. We were working with on a national search. Again, most of our clients come from referrals, so we never really know if we're up against anybody. It's typically a friend says, "Hey, Ashley, who do you work with?" And Ashley's like, "Oh, I work with Michael Novak." And it's like, "Oh, great." And so Ashley calls me, and I get to know her. And ultimately, she's like, "Hey, Mike thinks you do great things, and so he referred you. I want to know what exactly you would do for me, and then what's the cost?" And that's really the conversations at that point. It's not a lot of deep dives or RFPs. So back to your question of how we got from 2.4 to 3.6, there was a single family office that had been around for, gosh, I want to say 4 generations, that was winding down, that did not have a succession plan in-house. And ultimately, there was a national search of many firms. We got into the last 4, the last 3, the last 2, and we were the one that they selected. And so significant wealth came over, and that shows up in the ADV as well. And so, that was a big lift for us because we took on a single family office that didn't really have succession. So those 2 events is what you see in kind of that ADV.
So significant wealth, was that a purchase that you guys had made, or was it, did they just merge with you guys?
Yeah, we haven't acquired. We're not buying. We don't do M&A. And so this was a family that literally just came in the door. So, we just took on the work. So obviously all that showed up, but we're not doing any M&A activity. And again, I think if you look at the space, there's a lot going on right now. There's a lot of, if you look at David DeVoe, who's a good friend of mine and really involved in the industry, and you look at DeVoe's reports, there's some significant, obviously meta firms, as he calls them, that are growing significantly. Most of that's obviously maybe through M&A work as opposed to organic growth. But yeah, we're not doing any of that. I mean, I guess if our minimum is $100 million, let's say, and most of those RIA firms are 250 million with 1,000 clients, that's just not our space. And so we're not really interested in that.
Wow, that's really cool. Growing. I think you guys being able to have that company merge with you guys without having to purchase them. I think that's amazing.
Yeah.
Keep in mind, to have that type of growth in a year, where a lot of companies would, they would pay, several $1 million to get that kind of growth.
Yeah, we were very fortunate to be selected. And I think part of it was we were up against some national firms, some of those meta firms, some of the bigger firms. And I think the question is, what really is their target market? Are they true family offices? Are they really delivering service to ultra high net worth? They've got a lot of clients, a lot of billions and billions of dollars, but are they working with $100 million clients? Or are they working with $1 million clients? Nothing wrong with $1 million clients. That's a lot of money. But at the end, what's your niche? Like, what's the focus of your firm? And ours is obviously, higher touch, lower client count, and deeper relationships with families.
Well, thank you for sharing.
And you mentioned 75% of your families are outside of Cleveland, outside of Ohio. So nationwide, are they concentrated in one part of the nation, or really just all over?
It's kind of all over, Ashley, but we do have concentration for whatever reason in Montana. We have many families in Montana. I think in the Carolinas, obviously kind of in Florida, Naples area, but we're kind of coast to coast. We go from literally the Hamptons and Manhattan to, the West Coast and California, Napa. So it's kind of all over. And again, back to the point earlier about how we typically get new families, it's referrals. And so somebody either moved there or started there and they talked to one of their friends. And that's kind of how we've been fortunate to grow that way. And it's been great, kind of word of mouth that way.
Wow.
Fantastic. So Michael, over the years, what are some of the most valuable lessons that you've learned throughout your work in estate planning, tax planning? Any advice for those aspiring to follow in your kind of footsteps in building a firm of your size?
Yeah, thank you. I'd say, first of all, we're all in a client service business. Our assets are going up and down the elevator stairs every day. And so I think we have to acknowledge that this is very much a human capital business. So you have to have great people in order to execute, in order to get done on things. And I think the expectations of every client is a high expectation of service. And so I think the biggest thing is, make sure you have great people and level those people up and make sure that they can deliver on the pledge, commitment, promise that you make to every client that you work with. I would say second, kind of looking at growth, you have to embrace technology. Good people are really hard to find, right? People are easy. Good people or great people are hard to find. So how do you embrace technology through scale in order to make that, something that you can do as you grow a business? Kind of getting back to the latter part of your question, Ashley, on growth and kind of where do you start? I think ultimately thinking of some skill sets to be the trusted advisor, you have to be open, you have to be honest, you have to be vulnerable, and you have to be genuine, right? So these relationships, especially the deep ones that we have, for example, where they're bearing everything to you, there's obviously a lot of confidence and confidential data that they're sharing. But how do you create that relationship where, Mike, you might be afraid to really come forward and say something about a family issue, but as soon as you kind of talk a little bit about it, I'm like, oh, Mike, you think that's bad? Well, let me tell you about my family. And then you get into it and you're like, oh gosh, okay, we're all the same. We are all the same. Someone might have more zeros, but it doesn't matter. They all have similar issues. And so I think, how do you, again, we're client forward, client facing in the industry, not just Wellspring, but the industry should be. So how do you put that first? We don't lead, nor should the industry lead by their products or their process or that. They should lead with service. Now that just doesn't differentiate, because if someone said, what makes Wellspring different? And I say the strength of our relationships, every firm says the same thing. That's not differentiated, right? But I would say, to your question, Ashley, that is something that has to be, top of mind in the advisory, network of successful companies. And then you get to, all right, what have I learned from differentiation? So what are the things that as I've looked back, and I'm 54, as I look back 20, 30 years now, I guess, oh my gosh, of working in the industry, what are the things that I've seen? And I would say, again, this one phone call solution, holistic, again, I hate that word abused so much, but holistic one phone call. Could we do something where we're not saying, Ashley, I'm not the world's smartest man, and we don't have the world's smartest men and women here, but we're going to be good listeners and find out what you really need, and then we'll try to get a solution. If we don't know, we're going to tell you, never seen that, never heard it, but we'll help you figure it out. And so I think having that relationship, then being a good listener, and then finding solutions proactively for a client adds a lot of value. And then before you know it, you become their trusted advisor. You become the one that they call when there's an issue, financial, non-financial. On the path of differentiation, I think the one that we chose, obviously a couple things. The revenue model is a lot different, where it's not just an AUM thing. And that's just something that we started a long time ago in 2008. I can't imagine doing it today, because all the work that, it was easy when we were a simple firm and there was 4 of us, 3 families and 4 of us. It's like, how are we going to do this? A lot easier back then. But, I think our revenue model makes us different. I think the one phone call makes us different. And I think kind of this family governance and lack of better terms, our tagline is live well, sleep well. And now it's kind of like the be well. So how do we work on this be well stuff? And so looking at, this wraparound stuff for the family and looking at everything for the family. So I think you have to be differentiated. We've been fortunate because of our differentiation. I think that's helped our growth. But I'd say all those things are things that I've learned. I still make mistakes every day, just like everybody. But I think ultimately, if you're, we talk about the head and the heart. And I think if your head and the heart is in the right place, and we're really smart people in the investment business, the RAs, they're brilliant, right? We should be. We're trained, we're CFPs, we're CPAs, CFAs, we're certified smart. But at the end of the day, it's not just how head smart you are; it's partly how heart smart you are. And so, how do you work with both of those to have more genuine, established relationships? And by doing that, frankly, it worked really well for us, because that's where we started getting more and more families from kind of existing families.
Oh,
Thank
gotcha.
you. Yeah, I think you kind of went right into the next question I was going to ask you. I was going to say, what sets Wellspring apart? But gosh, you hit the nail on the head there. Thank you.
Yeah. Well, again, I think it's, I've helped a lot of younger advisors think about, how I started and how to get started. And I would say, again, the advice is differentiation has to be, we all kind of look the same after a while. I mean, I think if you look at the tech stack of a lot of firms, they're all using the same aggregators, the same financial software, the same reporting software. You're like, okay, so what really makes Wellspring stand alone versus another firm? If Ashley and Mike are looking and comparing it, like, so what is it? And ultimately, I do think the relationship has to be number one. But if everybody says our relationships make us different, then you can't be different, because everyone's saying the same thing. So what are the other things that you can differentiate? And again, going back to, I guess, my last comment, this, family governance, preparing the family for the money, it's just as hard preparing the money for the family as preparing the family for the money. But why aren't more providers or advisors trying to prepare the family for the money? So if a client says, what's the difference between being fair and equal? I don't know, right? So if you have 2 kids and like one is in the business, one's not in the business, and you say to one in the business, okay, you're going to get the business, but what does the other one get? And you want them to have the assets to be equal to the other sibling. And you're like, well, they're going to get a share of the business. Then the one who's in the business saying, well, why does my brother get it if he's not working in the business and I'm doing all this work? And so there are issues that come out in families. And so, getting through those conversations. And again, we use facilitation tools to really open it up and have, conversations around, the money messages and some of the things that really, I think, hurt families longer term, because, money's a tough subject, right? It's a tough one to talk about. So where do you start? And if you don't start, then you don't prepare them. So you got to have conversations around it.
Yeah, what I've seen, in the individuals that I know that have extremely high net worth there, is that, it's while the, let's say they're this instance for sake of conversation there that I could talk to you about, this gentleman was getting older. He was around, encroaching upon like 75 years old, and he was remarried, and the 3 kids were like, well, we don't see why, she should get an equal share as us, right? And but the thing is, we're talking, I mean, we're talking about several $100 million, right? And I was like, you know, I would hope to God that, my family would never have that conversation. I think it's, while that individual is still walking the earth, why is everybody talking about how much money they're getting, right? When
Yeah.
they're still getting so much.
Yeah. Yeah. I mean, one of the questions that I would probably ask the next gen is, that's your parents' money. It's not yours. Why do you think they should even give it to you? Right.
Right.
And so, like, that's part of the entitlement, right? So that's our money. Well, is it really? What if it all goes to charity? There's a lot of families we work with that say, here's the number that I want for the kids to have, because I don't want them to have that much, and everything else goes to charity. Philanthropy is a big piece of our the families that we work with. And so I think, those are the conversations that that's a great example, like, because it's so hard to talk about that. The parents might be like, I'm not talking about it.
Mhm.
And so the kids don't know. There's all these things, and then the father dies. The stepmom, let's say, or whoever, gets this stuff, and they're like, let's sue this and go after this will and do that. Where if there was more transparency, which unfortunately brings up conflict, because the more you know, the more questions you have. But if there's more transparency, more conflict while they're all alive, you can deal with those issues. But it's hard, right? So people like, I'm going to stick my head in the sand. I don't want to talk about it. So
Right.
unfortunately, that's what a lot of families do.
Yeah.
And you can do that. That you might say, and I've heard clients say, well, it's their problem. I'm going to be gone. I'm dead. It's their problem.
I can only imagine some of the conversations
I know. I was just going to say that.
on in the family disputes. It's like you're sitting at their kitchen table with them.
Yeah.
Especially the individuals, that they're expecting, they're expecting, they're done, right? They're early 40s. They're going to retire. They're already shopping. They're already shopping for their place in the Hamptons, and and then they end up getting a much smaller amount, or maybe none at all, right? Or it's like, what I've seen is, hey, the father passes and he leaves his grandkids more money. I think it's a generational tax thing. That
Yep.
he'll leave the grandkids
Generation
more money.
skipping. Yep.
Yeah, more money than the parents are getting, or and I'm like, wow. But let me ask you this: what do you see as the future for your organization there in the next
So,
5 years?
yeah, that's because we're working on that right now. That's an interesting question. So here we are going to be going on 18 years, and again, we've been very fortunate how we've grown. I think your limitations are always going to be, human capital capacity, like how many people you have. We're very high touch, as is most of the industry, and so how do you find talented people? Ultimately, so my role has changed. We just recently hired a president here. So my role used to be CEO and president, and now my role is CEO, and we have a new president. Jeff just started. Jeff will probably see this. Jeff just started 3 weeks ago. I'm sure he feels like it's been 3 months or maybe even 3 years by now. But ultimately, looking at the business to build more scale and capacity. I think fundamentally, some of our consistent pledges, commitments to clients is we want to have controlled growth. So we don't want to grow at the expense of a current client. So let's say, Mike, you're a great client and I've got you right now. And then Ashley is over here, and Ashley's this bright star and she's got a lot of money, and I don't talk to Mike anymore. We can't do that. Like, so how do we transition Mike internally? It could be a question like, what you went through yourself, but how do we build advisors up so that you have a trusted relationship with them and not just one person over and over and over again? And so the consistency of that, right? So your team knows everything about you and your kids, and everybody on that team knows everything about you and your kids. And so, again, how do you build up that capacity so we can have controlled growth? Because that's important. Every one of our clients, and this is a great compliment I heard many years ago from a client. They said, when I meet with Michael, I don't know that he has any other clients. And if I could deliver that consistently, that's the best. Where they feel like, oh my gosh, you do everything for me, and they don't even know that you have another 19 families or whatever, on that team. And so that's ultimately, a big issue as we look forward at growth. I think the industry has changed a lot. There's a lot of, obviously, private equity now in the industry. We are still independent, and that's something kind of, we're fiercely independent right now, where there's a lot of other M&A activity going on in the industry, especially at maybe our size. And so how do we remain independent? How do we compete with that? In a way, I think, again, maybe because we have this kind of this niche of ultra high net worth families and kind of this, all the stuff that we talked about with family governance in the fee model, that's probably a little bit different. And so that helps us. But ultimately, the industry is going to get smarter. And so, it's a great question. We're always trying to stay ahead. We're always looking at next technology. Again, we're looking at kind of this Be Well thing that I talked about the wrapper of health and wellness and all these other things. And so how do we look at all those things ultimately to help deal with families? But those are, some examples. But it's interesting now where the industry is and kind of where we're seeing it going. And at some point, I asked the question to the larger firms: is there going to be there's this huge acquisition going on, and at some point, if I'm a young advisor at one of these large firms that gets acquired and gets acquired and gets acquired, and I'm not in the capital stack where I have equity, I'm going to be at the same day like, well, maybe I start my own business. And so is there this rotation that happens in 5 or 10 years where a bunch of junior advisors say, well, I don't like this big firm and we're not doing it, so I'm going to go off and start my own thing. I think that could happen. I don't know. It'll be interesting to see where that goes, because there's been such a push for acquisitions over the last several years, but even the last 10 years.
Yeah, I mean, I think a lot of these, individuals, it's kind of, it used to be, what's the race to get to 100 billion, 250 billion, and now you're seeing some of these guys clip a trillion, right? And it becomes more about revenue than profitability. I think
right.
With some of these individuals, you see so much M&A action and so much rolling up going on.
And unfortunately, maybe more about revenue profitability than client. And so I think that's the issue that might start, surfacing is, and I think so far so good. The clients have been happy, right? These larger firms have been providing value, and I think that's great. If they focus more on return than client relationship, I think that could be an issue. But so far, I think the industry's handled that well. I think that's something that they have to maintain, because if not, then I think families, clients will start, voting with their pocketbook and say, well, I don't really like this relationship anymore. I'm going to come over here where I feel like I am one of a smaller set, or I am not just a number, I am Mike or Ashley, and I've got a better relationship. So that could happen. I think the industry has to be careful about that.
And so let me ask you this: what do you take it back to 1990, late 80s? You had the big wirehouses, the Schwabs and Goldman Sachs, and then you had such a small amount of independent RIAs, and now that's been growing so much over the last 30 years, I'd say. Do you think it's going back back to where it was in 1990? But it's not going to be necessarily the Schwab or Fidelity or Goldman Sachs, but it could be Apollo and creative planning, and these guys taking their place.
Sure. First of all, when you said 80s, I thought of like parachute pants and a mullet. So I grew up. Unfortunately, you put me in a place where I shouldn't be. But I don't think that I think that the wirehouse model is still there, and I think it's getting fragmented, obviously, where the independent RIAs. But part of what's driving this has been demographics, right? So if you look at the average RIA, it probably looks like a shop that has 250 million to 400 million, where the lead advisor is in their 60s, probably a white male. And so you look at that and say, okay, well, what's driving a lot of this is retirement is driving some of this. I'm not saying all of it, but retirement of these older advisors. I mean, there's not enough young advisors coming into the industry. And I think one of the things that I love to see, we've got a great internship program here, is there's a lot of colleges now that just don't have a finance major, but have a finance with a concentration in wealth management. So literally what happens is 5 years ago, I would hire a senior coming out of college, a finance major. And then we would take that person and put him through the CFP classes for 2 years and all this other stuff. And now we can bring an intern in as a junior rising senior who is on this wealth management track, who's taking, as part of their curriculum, CFP courses. So they're taking these classes, and then we bring them in between their junior and senior year, and it's all about work ethic, integrity, how smart are they, and we get to know them. And then when they graduate, we're like, all right, you're coming back, and now we're going to hire you. Because now we know who you are, and you've proven yourself as an intern. We know you're a CFP, because basically you can't say you're a CFP yet because you don't have the years of experience, but you have the education, and we pay for you to take the class, and now you've got the degree, but now you've got to have the certification by years. So, we have to do a much better job, whether that goes to, engaging next gen advisors, giving them opportunities to be maybe client facing, looking at the diversity of our talent pool. I mean, there's not a huge diverse talent pool to choose from. And so how are we going into the community in order to build a more diverse talent pool? So we created a scholarship for persons of color to try to go into high school, going into college, to give them opportunities and to try to get them, hey, we'll help you with college and we'll teach you about wealth management. Wouldn't it be great if that worked out for both sides? If it doesn't, they still have a great opportunity in college. And so, how are we doing all that? I don't think, sorry for the ramble, I don't think, to your question, I'm still stuck in the 80s. I don't think I don't think that the industry is going to go back, because I think it's too big now, right? And I think the REAs and the big acquirers are so big, and private equity money is in until it's not. And so what's the future of that? You can only go so far probably before, is there another IPO like Focus did, but now Focus is private? Are there large firms that can remain independent? Like you think of the accounting and law firms where they're still, huge firms, but they're not publicly traded. They're still privately owned. And so what's the model? The AUM model is different, right? It's different than a law firm model or accounting model. And so I think that is maybe some of the allure to investors, where you say, oh my gosh, this is kind of a sticky asset relationship. And yeah, even if there's not organic growth, if the market 85% of the time goes up, over time, that revenue stream continues to go up. So as long as you retain those relationships, that's not a bad investment, meaning from an acquirer. So I think the large firms are going to be there. I think there probably is going to be a moment where some of the next gen that is now getting into the business is probably going to look at what's happening and say, okay, I want to do something different. And so there probably will be that split off coming. There's a big gap right now. I'd say there's a lot of 20 and 30-year-olds and a lot of 60-year-olds. And
Right.
So that gap between 30 and 40-year-olds, there's not a lot of them. But they're getting smarter. And for me, that was one of the decisions where I kind of looked and said, okay, I don't want to be in my 40s and say, what would it have been like if I tried doing something? And so trying to do that. And I think there's a risk clearly to do it. I was fortunate that it really worked out well, but there's a big risk to set up your own company and try that. So I do believe that there's going to be some rotation. I think the big firms are here to stay. And I think they're getting better every year with technology. They're looking at, all kinds of add-on services to be, whether it's insurance. And I guess you question independence and objectivity. If you start selling things, we don't sell any products. So if it's insurance, we work with an insurance advisor. But they're looking at, can we add new models? Can we do insurance? Can we do these things? And again, as long as they're doing it, in the best interest of the client and the firm, then I think they're doing it well, and they're probably going to stay in business.
Yeah, and what do you when you talked about the advisor scholarship program, which I think is amazing, by the way, had you guys ever hired anybody right out of high school and put them through your program? Or
it's interesting you asked that, because there's a local parochial school called St. Martin de Porres here in Cleveland, an awesome school. They have this work program where we started this year with our first student. His name is Brian. So Brian started on Monday of this week. Brian we hope will be with us through his entire high school career, from freshman year through senior year. Brian works for us once a week. So he's in here one full day, once a week. And again, we don't want it to just be making copies and doing stuff, but ultimately, if we can get him more engaged and more involved, he's a freshman. So you say, well, I didn't know anything. I probably still don't. I don't know anything as a freshman in high school. But I think, how do we get Brian engaged and get him working up in the organization to get him more interested in this field? St. Martin de Porres, we give them a gift, a charitable gift for that, right? So that we have a relationship with them. And a lot of firms, there's other firms in Cleveland that are doing that same thing. And so on a national platform, I think there's other schools like that. But, we're trying to go down to the high school level to educate them about the space, to train them about one of our directors, Shira, has a service where she goes and she speaks at schools about what is a budget? How do you put that together, right? So we need a lot of financial literacy in the industry. So if we can start on many levels, we are going to increase the talent pool. We're going to broaden the education for everybody. And I think everyone will start saying, oh, that's great. And then frankly, it's kind of like a rising tide raises all boats. I think all firms will do better over time because of that.
Yeah. And you said something earlier about, there's not a lot of new talent getting in the industry. You said the 20 to 30s and then the 60-year-olds, right? And so being that the average age of the industry is about, I looked it up, it was, and I don't listen to everything Google says, but it said it was 59 years and 3 months old was the average age of the advisor, right? And
so you're saying I'm young, right? I'm going to say that to my kids now.
Spring chicken, man. So, and if you take a look at that, right? Do you think that there's going to be more people retiring than there is getting into the industry?
I think if going back to the College Board, if the CFP does their job well, and we do our job well, and the educators, which now that they're offering these majors, do their job well, I don't think it's going to happen because, frankly, I'll contrast this to the accounting industry. So I was an accounting major at Ohio University and then got my CPA. I didn't really like accounting. I don't know a lot of accountants that really love it, right? But I did it because when I was a junior in college, all of the finance majors weren't getting jobs in 1992 when I was a junior. And so I was like, all right, my parents said your job in college is to get a job. And so I was like, well, if I'm an accounting major, I'm going to get a job. And so I was kind of a dual major and focused on accounting. So looking at that, looking at the accounting profession and contrasting it to your question, I'm trying, this math might be, you can make up whatever numbers, right? But the math directionally is, I think there was 300,000 post-COVID, 300,000 accountants that were retiring to 50,000 a year coming in from school, from graduating. So the accounting industry is really struggling. And so you see that in wages where they've got their starting salaries are really big. Why? Because there's just not much. And so if the three of us are accounting majors and we're entertained by 20 firms, that's the three of us. And so, we're going to compete. They're going to be competing against each other for 3 spots. I think the difference from the we'll say financial planning, just the CFP, one is, I hate to say this to the accounting industry because I'm a CPA, it's more interesting sometimes, right? There's more stuff you could do. So you could focus on wealth management. You could focus on investments. You could focus on financial planning. You could focus on estate. You could really do it. You could do it all, and you could be holistic. It's like a puzzle piece. And so I think it's a more interesting field for some. I mean, I looked at, I've got 2 boys. One just graduated from Michigan as an engineer. The other one's a junior at Boulder. He is a wealth management major at Boulder. And both of them took accounting, and both of them got A's. And both my engineer son said, Dad, AI is going to take that over. I have no interest in that. And my junior's like, my youngest one was boring. I did really well, but I have no interest in it. And I think that, how does the accounting industry make it more interesting? And then, so I think, again, I feel like I'm panning the accounting industry. Accountants are great, but, and I'm an accountant, and I'm a CPA, but I think ultimately, I think that college students are seeing, wow, there's a lot of fun things. I mean, the intern program that we have, we put them through basically all the departments. We put them through tax, we put them through investments, we put them through financial estate. So they get to see everything. Most of them don't like tax as the most interesting topic. Like I hate to say, it's not the one that they look at. They say that's the most exciting. Some do, but most don't. So I think, how do we look at the profession? I think there's a lot of opportunities if the teachers do it, if the college board does it, if the universities do it, and if their jobs, which there are plenty of jobs, right? To your point, there's a lot of retiring advisors. And so when you look at this, we've got to bring this next gen in, and we got to bring them up. And so, that's a huge issue for the industry.
Mm-hmm. Yeah, thank you. I appreciate your insight on that.
And switching gears a bit into investments, Michael, what strategies or sectors are you most excited about right now? And how do you think they will influence the long-term wealth creation for families and individuals?
Yeah, this is going to be a very boring answer, Ashley, and I apologize. But I think
I'm sorry,
your answers so far have been so good. I
get it.
When we look at investment management, right, as part of our services, we have the public markets, stock, bond market, public market, liquid markets, and then we have the alternatives. We keep it very, very simple on the public markets, where it's primarily an all ETF approach, where it's very low cost, very low taxes, where it's consistency of returns. Because frankly, the secret is it's not what you make, it's what you keep, right? So how do you have a more tax efficient portfolio, a less costly portfolio to have higher net fees than somebody else? So if you're a manager and you're like, hey, I can give you 12% a year, and I'm like, well, I give you 9, but you look at it and your turnover is 40, 50% a year, and you're getting paid 1% a year, and I'm getting paid 0.25, and I have very little turnover. all of a sudden my fees might be in the 8s and yours are in the 7s. And so you look at that and say, well, wait a second. So, and the industry doesn't really do a good job of showing that. So we educate clients on net returns after taxes, after fees. So as far as sectors and everything, I mean, we look at more globally. We have a strategic asset allocation framework that looks at the public markets and the private markets. I think where we're most excited, obviously S&P and large cap has done very well. I think most managers that have performed well probably have less international than other managers. They probably have less small cap than other managers. I think there's opportunities there going forward in both of those as the Fed kind of looks forward. But ultimately, we don't really look at it from a sector by sector basis. What we spend more time is on the private assets, private equity, private credit, real estate, because again, if a family comes to us and they're $100 million, they want to be $100 million. They don't want to lose, right? And so we're pretty consistent as far as returns, but then finding top quartile private managers, again, in private credit, private equity, and real estate that can deliver better returns than the S&P. Again, it's illiquid. There are higher fees to that. There could be more taxes, but you have to balance that all together. And so if you think about it like an endowment, right? If you have a university and has an endowment, where are they from an asset allocation? That's kind of how we take it. Because for a lot of our families, this is generational wealth. It's not just, I'm going to retire and I need all this. This is generational wealth. So, and sometimes you might say, well, we're similar to endowment. Our time horizon might be 100 years if it's generational wealth. Or if it's generational wealth into a foundation, that could be forever because that foundation doesn't go away and hopefully it lasts multiple generations. So we have a different approach. A lot of firms have the same approach, but I would say other than like looking at sectors or, most of, a lot of our clients have the private assets. And so we're kind of looking at both. I don't like ultimately kind of where the industry's going on private assets, where now, Mike, you might be in the bar with someone talking and there's like, yeah, I've got this great private equity. You're like, I need some of that. What's private equity? And, it's different and not everybody has it. And so now you're trying to get into it and you go to your advisor and they don't really have a good solution, but they have a solution. And again, if you're not in the top quartile, if you're not in the top of private equity, but you're in the middle, you're just like the S&P. So why do you have all this inefficiency and more costs and lack of transparency to get equity-like returns in the market? You might as well just be in the market. And so we got to be really careful. And so I think unfortunately, a lot of firms are trying to get their clients into private assets, and they're looking at liquid alternatives and these other things where you just be careful, right? Buyer beware, where you got to look at, excuse me, I'm sorry. Buyer beware. I should have turned that off, Ashley. You got to look at like buyer beware for some of that stuff. So I think, again, I think the industry is always kind of leading and looking at new products and new solutions. I think it has to be the right fit, but in every case, looking at one of the things we do is look at risk adjusted returns. So it's not what you make, it's what you keep. And also if we can, if you think of a bell curve, if we can lop off the back end of the bell curve as far as negative performance and get, 1.3 as far as more upside and less downside, we will be top decile as a manager overall. And so that's kind of our goal as far as risk management as well.
And what going ahead and after the election, what do you think the future of wealth is looking like right now? We've had some really good years, after COVID, and I mean not 2022, but there's been some good years in the market. I don't know if that's just from a certain select few stocks in there, but what do you think is going to be taking place there?
I mean, obviously the Mag 7, NVIDIA, for example, the Mag 7 has led a lot of this performance over the last couple of years. But I think ultimately, the election is going to be a tough one, whether you're a Democrat or Republican. I think, ultimately, everyone, we're all human beings, so we're all emotional, right? And so the one thing I think we all have to be reminded of is turn off the noise. The president doesn't really have that much control over policy. I mean, it's got to be everything. And so if we've got some clients who's like, if so-and-so gets elected, I am leaving the country. I'm like, all right, where do you go? Give us a better country, the United States, right? That has all these things. But ultimately, if you think of tax policy, if you think about the economy, the economy is really, I don't want to be oversimplified, but it's really two things. It's the three of us as consumers, which is 2/3 of GDP. And then frankly, it's policy from the Fed. It's just as simple as that, but that really drives it more than what the government's doing. Unfortunately, when we look at what the government is doing now, and you look at post-COVID, they're spending trillions. And so the government has unsustainably gotten into this game, but traditionally it's been consumer-based, right? So I think to your point on the election, what does it look like after? Tax policy is going to be a big driver of what things look like.
And Michael, sorry to interrupt. When you said the government's gotten in the game and spending trillions, you're saying, pre-COVID and previous years, we weren't afraid to take on as much debt as we've been taking on in most recent years?
We didn't spend as much. So when COVID hit, obviously nobody knew. I mean, we shut the economy down on purpose. Okay, so what happened? The S&P was off in 23 days, almost 30-some%. So I mean, everything, because we shut it down and the economy gets shut down, two things happen. We stop spending because so if we're 2/3 of the economy is going to go down. And so you can look at like oil or the airplane industry is the worst case of that, right? No one flew. And so what happened to the airplane stocks, right? So that's an extreme example, but ultimately post COVID, the Fed cut rates to zero. And then ultimately to try to spur the economy as far as business growth, individual growth, spending. And then the government came in and they had a lot of programs. If you think about the fiscal stimulus that they started back then, they had a lot of programs that they were spending money on where you're going to get, $1,000, $3,000, depending on your AGI, where everybody got a lot of money. And so what's happened since then, Mike, is okay. So our debt as a percentage of GDP is almost 100%. So it's getting closer and closer. It hasn't been that way since like World War II, and we were in war. And so you look at it and say, why are we spending so much? Why is the government right now? We've got high interest rates, so that to maintain the debt that's increasing every year, we have to pay more because think of it as a mortgage. If you had a 4% mortgage versus an 8% mortgage, so your mortgage rate's higher. So right now instead of a 2% debt, we have a 4% debt in the government. And so all of a sudden the servicing goes up as far as our interest costs. And so if we keep this up, the maintenance of our debt every year is going to be more than our defense budget. So what are we going to do as a country? No one's talking about that. I wouldn't get elected if I said, hey, Mike, I'm going to raise your taxes and actually you're going to get less benefits from Social Security, Medicare. Neither of you are going to vote for me. So I don't tell you that. But ultimately, that's kind of what's going on. So we keep kicking the can. And I think ultimately that is, your question kind of was like after the election, typically if you look at election cycles, obviously there's a lot of volatility before. We haven't really had it this month of September, which typically September is not the best, but ultimately a lot of volatility before the election. Why? Because everyone's worried about what's going to happen. And then the election happens. I mean, think about when Trump got elected in 2016. The market was off like 4% overnight, and then 2 days later was flat. Because you kind of know, all right, well, here's what's going to happen. And it's just the uncertainty. We don't like uncertainty as human beings. And so ultimately, there's probably more volatility before the election. There's going to be a little volatility after election. And if the Fed keeps cutting rates, the market's going to chug along. It's not going to do that bad. There's really nothing, that we can see at least. There's not some huge, issue that's out there that's this, that's a bubble that's going to pop when you think of, back at the, 2001 with the internet bubble. I mean, ultimately, you've got AI that's highly priced. You've got some large companies. The debt crisis probably is coming with commercial real estate, where there's a lot of commercial real estate that's underwater. And there's a saying, extend and pretend, where the banks are like, we can't, we're going to give you another year on the note, Mike, and then we're going to come back. Or we need you to put more money in your loan covenants. You're missing those. But none of these banks want to default on all this because commercial real estate is really going to have a tough time. And so there's a couple things under the hood. And I think, there hasn't been a recession maybe that people thought was going to happen last year. Why? Maybe there's rolling recessions where there's like mini recessions and different things where maybe it was small cap or maybe it was oil at one point, or maybe it's commercial real estate. And so it hasn't been everything yet. At some point, we're going to have a recession. Hopefully it's not the COVID recession or the global financial crisis recession, where it's just kind of your Fed-induced recession where you get to the tipping point. Obviously, the Fed's trying to stop that by reducing rates. I think what the Fed's done has been amazing so far. When you think about the soft landing, if they can still do it, we're kind of there right now. I think Jay Powell, as people call him now, Jay Powell's done a pretty good job with the Fed on that. So, but I think longer term, we've got a debt issue in this country. We've got a demographic issue in the world where we've got older people and less young people. And so when you think about any system, something is going to break at some point. Fortunately, I probably won't be alive when that happens. My kids might. And so I think that's an issue that we as a country need to figure out, but no one really is talking about that. You're not going to hear that in this political cycle.
Yeah. Thank you.
Well, I hate to end our conversation today, Michael. It's been so insightful, but I think that's all the time we have today. Thank you so much for joining us on the show, sharing your wealth of knowledge and expertise with us and our audience. It's been such a pleasure having you on.
Thank you, Ashley. Thank you, Mike, for having me. This was great. Really appreciate it.
We appreciate you. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Be sure to join us next time as we continue to explore topics that truly matter. Until then, take care and stay curious. Thanks, everyone. Thanks again, Michael.